A stock is said to be undervalued when it is being quoted at a price that is assumed to be below its true value. Needless to say, finding and investing in stocks that are cheaper than what they are worth is not only rewarding but is also less risky to the investor. And therein lies our predicament. How can everyday investors like you and me identify undervalued stocks? It's a question we have posed to ourselves many times, and in this video, we shall present a simple yet analytical framework on how even a beginner can discover quality companies at delicious valuations. Let's begin. Whether you are a retail investor, equity analyst, or a fund manager, the journey of spotting stock pricing discrepancies almost always starts with a stock screener. Simply put, a screener is a set of tools that allows investors to quickly sort through a large universe of companies according to the investor's own list of criteria. In fact, one of the earliest screeners to find undervalued stocks can be traced back to Benjamin Graham, who is often referred to as the father of value investing. Graham's screener used a lot of basic valuation metrics like P/E ratio, dividend yield, earnings per share, net current assets, etc. And his focus was always on discovering companies with a strong balance sheet, a consistent profitability record, and most importantly, the stock should be available at a super cheap price. While this approach worked well in the 1930s and 1940s, over time, newer ways of valuing companies were introduced with a mix of both the numerical and the qualitative factors. For instance, Warren Buffett, who ironically was a student of Ben Graham's, advocated an investing style that looked beyond cheapness and used some simple guiding principles to determine whether a company was investment worthy or not. In fact, whenever I look at these 12 bullet points, it always gives me this calming feeling that profitable and long-term investing is simply about common sense and following a tried and tested process. Now, the reason we talked about screeners and principles is because modern investing often requires the use of both techniques, which will get even clearer as we hear from DSP Mutual Fund's Kalpen Parekh on how anyone can use a simple three-step process to identify undervalued stocks.
In our value fund, we start with this concept. So what do? We look for massively eliminating companies which have either poor earnings quality or where we have seen over long periods of time cash flows and profits getting diverted out, companies which have very stressed working capital cycle or have governance issues. Now, these are nice words to look for elimination, but how do we look for data which can signal to us that the earnings quality is poor? So we look at various ratios which can validate the authenticity and sustainability of the profit numbers, the earnings numbers, or the cash flow numbers. And financial statements every quarter and every year when the balance sheet is made give us these signals. So for example, if a company has depreciation rates which are significantly different than the depreciation rates of similar companies in similar sectors, then that can become a red flag for us to investigate or give a poor score to such a company. Or if a company has earnings ratios which are outliers, or their operating cash flow has huge mismatches. So these are some variables which indicate poor quality of earnings. I mentioned the second point, which is how can we track only looking at data that funds could be diverted in businesses. So we look for various metrics like companies where there are very high and frequent number of related party transactions. Generally, companies with high related party transactions don't get a high score in our scoring model. We look for companies where the share pledges are very high. Ideally, the best companies which have generated wealth over long periods of time are companies which don't have very large leverage, or promoters which don't have very large leverage. So the opposite of that is companies and promoters which have actually put their equity aside and taken loans against that equity. So that can be seen through very high degree of share pledges. So that becomes a red flag, and companies with high share pledges get a low score in our scoring model for elimination. In terms of governance, thankfully today, because of transparency in data and availability of data, a lot of external agencies give a score to companies like the ESG score or shareholder friendliness score through proxy voting firms. So whenever we see companies getting downgraded by some of these external agencies, we evaluate the reasons for that, and again we score a company negatively. So these are few quantitative techniques that we utilize to see how can we identify list of potential losers and give a low score, and thus automatically eliminate these companies from our selection bucket. So that's the first step in our value fund.
Alright, so these were some really good pointers, and just to give you a flavor of how that works in real life, let me illustrate what an irregular depreciation charge might look like. So say there is a car leasing company that you are analyzing. Now this company has defined the life of a car as 5 years, which is actually a fair assessment, and uses the straight line method to charge depreciation on the cars each year. So since each car has a 5-year shelf life, that would mean a 20% depreciation that gets provisioned in the P&L account. Now let's assume this company has 10,000 cars and each car costed 10 lakh rupees. So that's 1,000 crores worth of assets. 20% of 1,000 comes to 200, which means a depreciation charge of 200 crores is taken to the company's profit and loss statement. Now during the year, there was some shakeout within the company and a new management team was installed. The problem that eventually came out is that this new management team totally lacked any kind of moral fiber. And what they did is that they got these assets revalued and concluded that the life of a car is not 5 years but is now 10 years. Which means by one stroke of the pen, a 20% depreciation has come down to 10%, and what was a depreciation charge of 200 crores is now just 100 crores. And as a consequence, what was originally a profit of 100 crores is now a 200 crore profit, which, while it gives an immediate 100% boost to the company's profits, it does come at the expense of the long-term stability of the company. And these are precisely the kind of companies that one should avoid. In fact, Charlie Munger has this great quote on it that goes something like this: "Tell me where I am going to die, so I will never go there." Which is another way of saying that the first thing one should do as an investor is to avoid companies that fudge their accounts, have complex balance sheets, or where the cash flow doesn't reach the investors. Now, we can't deny the fact that DSP Mutual Fund, or any other fund house for that matter, will have access to a lot more metrics and information as compared to the everyday investor. But if I take the checklist that Mr. Parekh has just presented, we still think there is enough to help us screen out the negative companies using a standard stock screener. For example, a good way to measure irregularity in depreciation is to check out the depreciation to EBITDA ratio, which basically means the percentage of depreciation that is charged against the company's operating profits. Investors can track this metric across many quarters and, if possible, can also compare it with other similar sized companies within the same industry. The same approach can be applied to many of the other items in the elimination list. And while the screener might not give you everything, we do think there will be enough to knock off the more visibly bad companies from your list. Okay, now that we have a cleaner, more useful list to work with, it's time to separate out the better companies. Let's understand from Mr. Parekh on how we can go about this process.
Now, how do you define a good company? Quantitatively, one metric which is a good definition for saying that these are good companies is ROE, return on equity. So for every 100 rupees that a company's management or promoter has invested in the business, if that business can earn, for example, 15% and above threshold levels of return on that equity, generally and over long periods of time across market cycles, then one can say that these are good companies which have good chances of survival across market cycles. Now, why 15? Why not 10? Why not 20? because this number ROE of 15% is also in context to the prevailing levels of interest rates. So a country like India generally has 7 to 8% rates of interest. So cost of capital is around 9 to 10%. Companies which are able to earn meaningfully higher than the cost of capital are able to create value for their shareholders over long periods of time. So high ROE companies are good companies in our definition. Of course, we blend this with another dimension of companies which do not need a lot of capital to run their business. And here we have another filter of companies which don't have too much of debt on their balance sheets, or companies with very low debt, and thus their debt to equity ratios are very low. But to just simplify right now, let's focus on companies with high ROEs.
Perfect. So one simple way of identifying a good quality business is by using the return on equity metric. As a formula, return on equity or ROE is calculated by dividing a company's net income by its average shareholder equity. And more conceptually, what the ROE really tells you is the efficiency at which the company is generating profits. Simply said, higher the ROE, higher is the efficiency, and therefore higher is the quality of earnings. And we use this term quality of earnings quite intentionally because typically you will see higher ROE numbers in those companies which have strong competitive advantages, which in turn translates into higher shareholder returns. Now, it is generally assumed that it is only the large cap companies that have the capability to generate a high ROE, but that's not true, because we see companies capable of delivering 15% plus ROEs across the spectrum. Of course, do remember this 15% is just a signal and will obviously vary from industry to industry. But from what we too have seen, a lot of studies tend to tag 15% as the number to beat, as it gives a good buffer over the company's cost of capital. So look out for the ROE number the next time you dabble with that screener. And with this, let's move to the third and the final step in finding undervalued stocks. A well-managed company might make a great product. It might be a great employer, might have a great reputation, but that does not mean that this company will also be a great investment. And that's because the primary reason for any investment being a great investment or a not that great investment is the price that we pay for owning its shares. Let's go back to Mr. Parekh now and understand which metric can be used to ensure that we are not overpaying for a stock.
Price to book is the variable that we look for to decide for cheap or expensive valuation. If a company is currently trading at more than 50% premium to this fair multiple computed for this specific sector, then it is eliminated from our selection universe. By doing this, we eliminate companies which are in the highest bucket of valuation for this particular sector. Take tech companies, for example. The last 1 year has been a year where digitization has become extremely popular as a theme in investing globally as well as in India. And tech stocks are very popular. Tech companies are generally companies which are high quality because they don't have any leverage on their books. They generate free cash flows every year. They are highly profitable, but their growth rates are relatively modest or moderate. But thanks to COVID, work from home, digitization as a theme picking up, there is a significant frenzy for investing in tech stocks. And a lot of money is chasing tech companies, thus leading to overvaluation in many pockets of technology, especially mid-cap tech stocks. Now, if we take price to book of this sector overall, the price to book ranges will vary from 4 times price to book to almost 20 times price to book. Our fair value range, for example, could be around 8 times price to book for the whole sector. So companies which are at a significant premium to this 8 times price to book would get eliminated. Now, these companies definitely could be great companies, could be very good companies, but they have got overpriced in this cycle purely because of demand supply, more demand for these companies and these stocks. So the role of value fund, the role of our discipline, the role of our quant technique is to ensure that we don't get carried away emotionally in terms of chasing the most popular companies in each sector, however good they may be from their business perspective. So here is where the discipline of keeping guardrails on valuation parameters becomes very important.
Alright, so if you're thinking what I am thinking, then the obvious question is why use the price to book ratio and not the price earning ratio? It's a question that needed a follow up, and the team at DSP Mutual Fund was kind enough to explain that while they could have used either of their metrics, the primary reason for leaning on the PB ratio was largely to avoid the cyclicity of earnings, which would give us some inconsistent companies. So, net net, a low price to book value, or rather, what Mr. Parekh says, a low relative price to book value is considered as a reliable indicator of undervaluation. For years, for decades, for centuries, investors have been trying to find undervalued stocks. Ben Graham and David Dodd took an asset-aligned approach to valuation. Warren Buffett embraced growth stocks with reasonable prices. Charlie Munger applied quality and intangibles. Joel Greenblatt formalized it with the magic formula. Bill Ackman employed shareholder activism. Monish Pabrai clones it. And today we have heard and learned from Mr. Kalpen Parekh a simple quant-based process for finding undervalued stocks. And according to him, it's really about three things. Firstly, remove all evil. That is, eliminate the bad companies as we did in step 1. Step 2 was where we identified the good companies with the use of the return on equity metric. And finally, there was step 3 where we created a valuation fence defining what was overpriced and what was underpriced, which was done using the relative PB ratio. In fact, to verify this ourselves, we took the top 30 holdings of that fund, put it in a screener, and it came as no surprise that 24 out of those 30 companies had a 5-year ROE of over 15%, and 29 of those 30 companies had an ROE of at least 10%. Similarly, we also checked for the percentage of pledged shares and found that most of the 30 companies had 0 pledged shares, and just one company had some pledges, but it was a negligible 2%. But you know what? Don't take my word for it. I mean, this is not a sponsored video or anything of that sort, so try out any screener, put in the top holdings of any fund, and soon enough you will start seeing a pattern on how that fund looks at stocks and where the fund management team believes that can find an oasis of undervaluation. And with this, we come to the end of this presentation. I sincerely hope you found this content useful and will be able to utilize some of the learnings in improving your own stock selection or fund selection criteria. And while we do understand that inputting companies, setting criteria in screeners, and observing patterns takes time and effort, we would still encourage you to try it once and see for yourself if you enjoy the exercise or not. Don't forget to subscribe to our channel, to share and like this video, and I look forward to catching up with you next week with another insightful video. Until then.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.